Hi, Tiffany Woodfield here. In this video, I'm going to go over how the US exit taxes work. If you're thinking of moving from the US to Canada, then this video will help you understand if you need to renounce your citizenship or if you're trying to avoid overpaying your taxes. Stay to the end to find out my personal opinion if giving up your US citizenship is really the best option. As a cross-border financial advisor and co-founder of Swan Wealth Management, I work with Canadian and US clients every day. Over the years, the question of taxes has caused so much stress to dual citizens. If you've moved so you can enjoy your next adventure or to pursue a career opportunity, the last thing you want to do is be worried about the IRS. So let's get into it. First, what is exit tax? If you think of it in simple terms, it's the last chance for the US government to tax you if you're a long-term green card holder or a US citizen. If you're neither of those things, then it likely isn't something you need to worry about. It's if you're considered a covered expatriate, you may be subject to the exit tax. And it's important to remember that not all covered expatriates are subject to the exit tax. Next, how do you determine if you're going to be a covered expatriate? There's 3 tests that help you determine if you're a covered expatriate when you leave the US. First, there's the net worth test. If you're a single person and your worldwide assets are worth more than $2 million US the day before you expatriate, you may be considered a covered expatriate. If you're married, then the amount is $4 million together of your worldwide assets. Now keep in mind that your home is also included in this amount. Next, there's the net income tax liability test. As of 2022, if your net income tax liability for the past 5 years is greater than $178,000 US, then you may be considered a covered expatriate. Now this calculation can be quite complicated and would recommend to work with your accountant on this. Finally, you'll be considered a covered expatriate if you cannot certify through Form 8854 that you have tax compliance for the past 5 years. It's really important to make sure you're up to date with all of your tax filings. Remember, even if you're a covered expatriate, you only may be subject to exit taxes. I would recommend that you speak to a cross-border tax lawyer before you renounce. Next, let's talk about something that can often trip people up. That's how the IRS determines the capital gains that are going to be included in your worldwide assets before you renounce. The IRS uses a market-to-market regime. What this means is the day before you expatriate, it's like you have sold everything at the fair market value. And if you have any capital gains from when you purchased that to the day before you sold it, those would be included. So if any of your assets have increased in value, you'd be considered having a capital gain that could be subject to tax. As of 2022, the first $767,000 US dollars of capital gains is exempt. However, you should speak to a cross-border tax lawyer to really calculate this because it can be complicated. There is potential tax liabilities from deferred assets such as an IRA. Make sure to include trusts, business assets, investments, personal assets, pensions, and retirement accounts. Finally, who should renounce their US citizenship? I can't give legal advice, but I can tell you from personal experience, it's different for everyone. You really have to look at your personal situation. If you grew up in the US and you really identify as a US citizen, when you move to Canada, it might not feel right giving that up. On the other hand, if you were always in Canada, grew up here, and you're coming home to your home roots after just working in the US, it might feel more natural. So I guess what I'm saying is, who do you identify as? Because giving it up shouldn't just be about taxes. Finally, if you're planning a move across the border and you have assets you want to protect, I suggest you schedule a call with a cross-border financial advisor. The biggest and most costly mistakes happen when you don't plan in advance. So I recommend you start sooner rather than later in building your team. Thanks so much for watching, and we'll see you in the next video.